Hello, you join me on the last Targets in Focus interview of the trading week. It's been another 5 days of tension surrounding the situation in Syria, and markets have been closely watching developments. We, however, are looking at currencies today, and in particular the Swiss franc and British sterling, to find out what kind of movements we could expect to see in the coming weeks and months. Well, joining me on the line from London is Geoffrey Yu, a senior FX strategist at UBS. Geoffrey, let's start with the Swiss franc. Europe's overall economy appears to be on the mend, but there are still jitters over regulations in Switzerland. Do you see the Swissie slipping further in the coming weeks against the euro, sterling and US dollar?
Yes, we do. We see the flow of capital out of Switzerland to increase over time, especially led by asset managers who really will be compelled to still to chase real and absolute returns in the coming months or so. We are already seeing this flow amongst our real money investors and even some private wealth investors, and though it hasn't really been enough to generate a critical mass, and we probably need to see confirmation of stronger Eurozone data, but we do expect this to materialize in time, and we really target a gradual up move in Euro-Swiss towards 125 or so on a 6 to 12 month horizon. However, there will not be any changes in SNB policy. We think they're very comfortable with conditions at this point.
Okay, so briefly talk us through your projections for the Euro-Swiss then.
Euro-Swiss, we do see a move to 125 1 month and 127 over 3 months before stabilising at 124, 125 level on a 12-month view.
Now, sterling has seen growing demand recently off the back of a possible interest rate hike by the Bank of England. It's just rumours now, but this is most notable against the US dollar. But against the euro, it's reasonably steady. We know the UK and Europe are very closely linked when it comes to exports. Do you think the price action we've seen between sterling and the euro has anything to do with overall industrial production in the Eurozone at the moment?
Probably not. Otherwise, we do think that the Eurozone should actually see stronger data generating stronger currency performance. If anything, it is still reflecting the market's difference in belief in forward guidance from the ECB and the BOE. So clearly we have an issue with the BOE not really having its forward guidance believed. So sterling's following pricing in interest rate markets, leading to sterling higher, whereas for the ECB, their cautions and warnings about further moves in the short end of the term structure, that is actually getting a lot more credence from rates market as well. So that's why the euro is actually consistently low and responding to Draghi's comments, and we think this will remain the case, keeping euro sterling at relatively depressed levels.
So what are your price projections for sterling against the dollar and euro over a 1, 3 and 12 month cycle?
So right now, euro sterling, we look at 0.84 on a 1 month and 3 month point of view, and over 12 months we don't see much change either, drifting higher towards 85 also, versus the dollar, and we do acknowledge that cable is going to be quite elevated at this point. So we see 1 month at 155, but BOE will start to have an impact at some point, or sterling will need to adjust naturally because with current high valuations, it'll be hard for them to sustain capital inflows. So we see a move towards 125 in 3 months and towards 140 on a 12-month view. And
just finally, Mr. Yu, what are you expecting to be the dominant driver in the next few weeks for these currency pairs? The Fed?
Well, at this point, I do think that the Fed will be the dominant driver throughout, not just for sterling or euro dollar, cable or euro dollar, but we know that the Fed has the ability to lift rate expectations for global currencies in general. So that would be the thing to focus on over the coming weeks or so before we go back to the idiosyncrasies of individual central banks.
Okay, we've just about run out of time. Thanks for joining me today. I'll be back on Monday with a look at why South Africa could be the place to be for investors right now and why Nigeria is not that far behind. Until then, have a great weekend. Goodbye.